So tell us a little bit about yourself and how you got into the tax world, specifically working. I know most or a lot of your work now is with real estate investors. So how'd you get from where you started to now?
Yeah, well, I'll take you all the way back to when I first decided that accounting was my major. I'll give you a quick little run through. I actually decided to first pursue civil engineering as my major in college, and I took like 1 or 2 physics class, and I was like, yeah, this ain't for me. But I've always loved numbers and loved math, so I was like, what is, a lot of numbers, a lot of math, little to no science, and I arrived at accounting. So I was like, you know what, I'm gonna do this. Ended up loving it. I love that it's a direct impact or as much a direct help to a business owner that, like, in my opinion, can possibly help someone. So started there, got my master's degree in 2020, which was fun, obtaining that through COVID. I actually had professors on Zoom vaping at one point, so it was fun to live through that experience. But got my master's degree in 2020, got my enrolled agent certification, which is a certification specifically given by the IRS, essentially making me a tax professional. Then got my CPA license in 2023, so last year. So it's been a journey, it's all been fun. I feel like the real estate network has kind of like, I haven't pursued it intentionally, it's just a niche that opened up, and with people like you and Christian and all these other real estate investors that I'm working with and helping the branch and the niche just kind of self-develop. So I love it. I think it's probably the best investment as far as tax code is concerned. So that's why we're here.
Nice. Yeah, and you mentioned, it being one of the best investments you can make in terms of taxes. But what's funny is, I think as a guy starting out in real estate, it was probably the furthest thing from my mind as far as what attracted me to real estate, right? Like when you're making 40 grand a year, your tax bill isn't the highest on the priority list. So for me, getting into real estate, it was the cash flow and wealth building and equity and leverage and all these different things. And I kind of stumbled into the tax benefit side of real estate, where I know there's people that literally invest in real estate only and exclusively because of the tax breaks.
Right.
And we're gonna get into a lot of that stuff here, but I know I mentioned we're not going to have a ton of time to cover each of these, so we're going to try something new. I brought a little timer today, so we're going to set 5 minutes for each of these 6 things, because I want to make sure that we get to any questions anybody has or anything. But so we're going to do 5 minutes, and then we're going to cut it off. It's going to be a hard timer, and so there's definitely going to be stuff we're not going to cover, but it is what it is. So we'll dive into it. Let's start with, I guess, accounting best practices, and part of the post was 6 audit-proof tax strategies, and we want to balance this idea of paying as little as possible in taxes, but also not going to prison, right? It's something we're probably not fond of. So tell us, what are some accounting best practices that we can do from April to March when it's not tax time that are going to help you or help us come tax time?
Yeah. I think that one of the best things that you can do is not only talk to your accountant during tax time. So you should be sitting down and talking to your tax professional multiple times a year. At minimum, I would say like 3 times. In my own experience, I've had clients that have sold properties or purchased properties, et cetera, and have done so without my knowledge, and then they're surprised at the tax bill that comes forth as those sales close and finalize. So on a scale of like 0, I don't talk to my accountant, but tax time, and 10 being I talk to my accountant monthly, like you should be closer to the 10 than 0. But yeah, just talking to your accountant, make sure you're maintaining good records, obviously. In the event of an audit, if you don't have records, if you don't have any support for what you put down on your return, it's gonna be an easy trap for the IRS to just zoom in and say, you know what, we're not allowing any of these deductions, so we're gonna adjust your income and this is the amount that you owe. So just maintaining good records. Honestly, if you can afford to do so, just hire an accountant and outsource a lot of the work that you would do normally. Because 1, they specialize in what they do. They're gonna maintain your records better than you can. They're gonna establish some efficiencies, and then it also leans to having those conversations with them more often than once a year.
Yeah, that makes sense. And at what point in someone's journey or career would you say it makes sense to, I mean, I guess as an accountant, you're going to say day one, right? But like, at what point is that tipping point where like, hey, you really have to get an accountant? You know, like, what advice would you give to somebody who's trying to make that decision on, do I need to hire an accountant?
It really depends. It's situation by situation, which you'll see a lot of these topics will be. But I mean, if you're like stressed out when you consider your accounting records, when you don't have the time to do it, you're so focused on maintaining your business and its operations that you just can't maintain and you can't respond to requests from your accountant, then it's probably time to outsource that activity. So, I mean, for some people, they can, run their entire show and have 5 to 10 rental properties and maintain good records and are able to submit to their accountant profit and loss per property, and then they're good. But I mean, if it stresses you out just thinking about an Excel spreadsheet, it's probably time to outsource to your accountant.
Yeah, and I guess for the person who's not quite ready to pull the trigger on hiring an accountant, but has a shoebox full of Home Depot receipts. This isn't me, by the way. But what would you say to that person? What's the 80-20, the Pareto principle rule of accounting, where they can get the maximum amount of benefit with the minimum amount of effort? What should those first couple things they do be?
I think the biggest travesty that happens is people see accountants as a cost as opposed to an investment. So what they'll try to do is do it on their own. And I had one client specifically this past year who has a handful of rentals, and up until this year has maintained and has done their tax preparation work on their own, and simply just wasn't taking the depreciation on all of their rental properties, and which we'll see later, that's a big expense to miss out on.
Wow.
So it's just people not knowing, people just trying to do it on their own and just being penny wise and pound foolish, as the saying goes. Any good CPA, any good accountant is worth his weight in gold, is what I like to think. So that plus it's my favorite, and I say that sarcastically, is people will send me like reels and TikToks about like, 21 ways to save on tax, and it's just like the most unethical and illegal things ever. So as far as misconceptions are concerned, like, stay away from TikTok, stay away from Sally on Facebook, stay away from people who don't have any designation behind their name, because they probably just heard from somebody that was on the street that does taxes that, what they said is what they repeat. So stay away from social media. Don't get your tax advice from social media.
The tiniest bit of truth that gets extrapolated into something ridiculous, right? Yeah. I always see the car ones. Oh, you can buy a Mercedes and you won't pay any taxes for 6 years.
Write off your G-Wagon and pay a little to no tax.
All right, there's our time. So we'll move on. Next topic is capital gains. So what are capital gains and how does that apply to real estate?
Capital gains, simply put, is just a gain from the sale of a capital asset. And what a capital asset is essentially any asset. I'm trying to think of how the IRS defines it. It's movable or immovable, tangible or intangible, that you expect to receive benefit from for more than one tax period or more than one calendar year. So it's broadly defined, but essentially some of the most common capital assets that you can think of are like obviously real estate investments, rental property. Technically this table's a capital asset, this chair's a capital asset, your computer's a capital asset. So as far as capital gains are concerned is when you sell a capital asset at it as a gain. And the reason why it's important when you consider real estate is because obviously when you sell that real estate and it more often than not appreciates in value, you can be subject to have capital gains tax upon sale of a rental property.
Okay. You were going to say something?
I was going to say that they're favorable rates if you hold the capital asset for more than 1 year, meaning that if I purchase a rental property in 2021, but don't sell it till 2023, it's subject to more favorable rates than ordinary income tax rates. So the highest bracket of ordinary income tax rates is 37%. The highest rate that you could be subject to on a capital gains end is 20%. So they're more favorable, but still important when you consider real estate, because you want to pay 0% tax.
Right.
You don't want to pay 20 or 15. You want to get that as close to zero as possible. So in the event that you do sell, get with your tax accountant so that they can structure it in a way to where you're in the 0% tax bracket for capital gains.
And so it sounds like there's long-term and short-term capital gains, right? And that 1 year is the differentiating point for that?
1 year is the differentiation point.
So how would that work if you're, let's say you're building, I know we got a couple builders in the room, is it from when you buy the lot or when you complete construction, or like how would the IRS look at long-term versus
Yeah, the IRS goes by first date placed in service. So once the construction is complete, granted, and we'll get into this later, that you're in the business of residential rentals. Because that's a delineating factor, because if you're in the business of buying and constructing and flipping houses, then the IRS is going to deem that dealer property and it's your inventory. So when you sell that property, it's subject to ordinary income tax rates, not capital gains rates. So the IRS is going to consider your intent more than they're going to consider like you're buying and selling homes or buying and selling a capital asset, because in that event, the capital asset is your inventory. So it's subject to ordinary income.
So is that because you're working for that income in a sense? Is that how they look at it?
Correct. It's almost like if you are in the business of buying and flipping houses, constructing and selling houses, it's viewed by the IRS in the same way that you would view somebody who buys and sells candy. Like the candy is that inventory. Okay. You're selling that candy to make a profit, so they're going to want to examine the profit motive to see if it's ordinary income versus capital gain income.
Okay. And so how does that, for that builder who isn't sure if they're going to rent it out or keep it, how does long-term versus short-term apply to that? Again,
it goes by intent. So in the event of an audit, the IRS is going to examine your intent. If you get to the final point of, constructing and renting out this property, let's just say, you don't find a renter, you don't find a tenant, and 6 months down the line you want to sell it, or a year down the line you want to sell it, then they're going to probably subject you to capital gains and not ordinary income, because your intent wasn't to buy and sell or to build and sell. Your intent was, in fact, to place it in service as a residential rental property and rent it out.
Okay. And what about primary residence, and we're dwindling down on time here, but what about primary residence?
Yeah, so it's a big one, because in the event that you sell your primary residence, if you owned and lived in the primary residence for 2 out of the last 5 years, with the 5th year end date being the day you sell the property. So if you lived and used the residence as your primary residence for 2 years prior to the sale, you can exclude up to $250,000 of capital gains and $500,000 of capital gains if you're married filing jointly. So essentially, like if you sell your primary residence, how many people are actually subject to those capital gains tax? Like how often do you realize the gain on appreciation of $250,000 or $500,000? Hardly ever. So I see a lot of people who are in the real estate industry or who are real estate professionals like everyone here. What they do is, in the event that they don't want to recognize capital gains on the sale of a investment property, they move into that property, live in it for 2 years, and then sell it, because then they can exclude some of that gain that otherwise would be capital.
Yeah, I remember Jana Perret we had here a couple months ago talked about the nuanced details of that one. So timer went off. So are there any strategies, you talked about those capital gain taxes, are there any strategies we can use to defer or reduce those capital gains? If Uncle Sam says, I'm hitting you with this short-term capital gains on this rental property you're selling, what are some ways that I can reduce that tax bill?
Yeah, so that's probably the best one to utilize. I mean, obviously it's not ideal for everybody, because not everybody wants to move into their investment property for 2 years. Like you can have a family, it's just not ideal. My wife obviously wouldn't be fine with moving out of our house. So sometimes it just doesn't work. But if you can do that, that's probably the best one, because you exclude the gain altogether. You exclude the tax from that gain altogether. The other 2 methods that I would recommend is the installment sale. In the event that you want to sell your property, and again, this isn't always ideal, you can utilize an installment sale and collect payment on the sale of the property over time. And what that does is it subjects the portion of the payments that you receive for any given year to those capital gains and not in totality.
Okay.
So you receive payments over, X amount of time, and you include that gain in your income for that given year, if that makes sense. We can talk more about installment sales later, but another big one is obviously a 1031 exchange, where people exchange one investment property of like kind for another property of like kind and defer that gain over and over again. And we had what was her name? You said Janet?
Janet Brett, yeah.
Janet come a few months ago and talk about 1031 exchanges. So it was a really good resource, and I think that's a great way to defer some of that capital gains. But again, it's just a deferment, whereas the Section 121 primary residence exclusion is a exclusion altogether.
And you mentioned the installments. I want to circle back. I had a conversation with Courtney Fricky today, who was our last guest. And I think one of the questions people always get on the creative finance side is, why would somebody ever do why would a seller do creative finance when they can just sell it?
Right.
And I think you alluded to that, right? Like there's a ton of tax savings or potential tax savings for a seller who's doing an installment sale versus making that $100,000 all at once in one tax.
Right. And I know that some investors like to utilize a bond for deed sale. So in the event you do a bond for deed and you collect payment on the sale of a rental property over time, you're only recognizing the gain from those payments in that specific year versus recognizing the gain all in 1 year. So it's another deferment strategy, again, which would take the backseat to the Section 121 primary residence exclusion, but still, something that you should consider when you sell a rental property.
So circling back to 1031, you mentioned that it's just a deferment. So effectively, I'm kicking the can down the road.
Correct.
What would be the benefit of doing a 1031 if all I'm doing is deferring those taxes to the future?
Right. So 2 reasons. Obviously, like you mentioned, it's a deferment. So you can buy a property right now for $100,000. Let's just say 5 years from now, it appreciates to $300,000. You're going to pay capital gains on the sale of that property if you just outright sell it of $200,000. Simple math. But in the event you utilize a Section 1031 exchange, if you have a property that I like and you have a property and I have a property that you like, we can exchange it, therefore not causing the event of a sale to trigger capital gains tax for both of us. So essentially what would happen is I would carry over what the IRS calls a basis, in layman's terms, it's just an investment or cost. I would carry over my basis into your investment property that I acquired. And in the event that I sell that exchanged property, 10 years down the road, I would have a excessive gain at that point. But what a lot of people do and what a lot of people utilize a 1031 exchange for is called the swap till you drop method of deferment. So what will happen is they'll acquire a property, let's just say today, I'm 27 years old. So I acquire a property at 27. I keep this property or keep exchanging this property until the day that I die. What happens at the date of death and when it passes on to my descendants is that the IRS allows a step up in basis. So let's just say I acquire a property right now for $1 million. I don't have $1 million. I wish I had $1 million. But by the time I'm 80 and I pass, that property could be worth $10,000. Upon the date of my death, the basis or the investment in that property passes on to my descendants at $10 million. So they can outright sell the property after I pass and not recognize any capital gains.
So they took that $10 million property and sold it for $10 million and $1. They're paying taxes on $1.
$1, correct.
Wow. Yeah, that's incredible. And what types of properties, I'm sure we've all heard like the like-kind investment. Mm-hmm. How do they determine like-kind, or what does that look like?
Like-kind simply just means either business or investment use. So it doesn't mean that you have to exchange another rental property for another rental property. It just means that any property that you acquire just has to have a business or investment use. So that means that I can exchange my 2-bedroom, 2-bath, multifamily unit for a parking lot.
Okay.
It gets that extravagant. I can exchange that parking lot for a condo. I can exchange my condo for a strip mall, as long as there's business and investment use.
But not Bitcoin or stocks? Or
correct. It's just real estate, right, space. With business or investment use attached.
Okay. Excellent. So timer went off. Next, you talked about a client who didn't capitalize on or didn't take advantage of the depreciation write-off. What is that? What does that look like?
Right, so what depreciation is essentially a cost recovery. So the IRS, sat back one day and was like, you know what? These individuals are spending hundreds of thousands on properties. What we're going to do is allow them to deduct each year an expense, and it's a paper expense. It's just an expense on paper. You're not actually going out and paying for depreciation. It's a paper loss or paper expense but they allow you to deduct a portion of the depreciation per year. And for residential rental properties, that depreciation period is 27 and a half years. So if you acquire a property for $275,000, for simplicity's sake, every single year you're going to deduct $10,000 as a paper expense on your tax return.
Right.
And it's beneficial because you're not paying for the expense, but it's still offsets the income that you would earn from a tenant paying you.
Right. And so for that, the client of yours that didn't take advantage of it, or either way, what happens down the road if I sell that property, I've taken this expense? How does that play into the sale proceeds and taxes due and all that?
Right, so because the IRS allows you to take those depreciation deductions year over year, in the event that you sell your rental property, you're subject to what's called unrecaptured Section 1250 depreciation recapture. And what that means is any depreciation that you've taken in previous years is totaled, and then that portion of the gain is recognized as ordinary income to the extent of 25%. So the max that you can pay on unrecaptured depreciation recapture is 25%. So it is, a downside. It's probably one of the only downsides in investing in real estate. But again, there are strategies to mitigate that depreciation recapture. So for example, I feel like I'm just rambling, and if you don't have an example in your mind, then it can just, go by the wayside. But in the event you acquire a property for $275,000, let's keep those figures, and you depreciate it for the next 3 years before you sell it, and you recognize $30,000 of depreciation. You sell that, you turn around, you sell that property for $400,000. The basis or the investment in your property has decreased from $275,000 to $245,000 because you've taken $30,000 of depreciation. And depreciation reduces your basis in your property. So now, instead of having a gain of $155,000, you now have a gain of $155,000. $30,000 of that $155,000 gain is subject to depreciation recapture, taxed at a maximum rate of 25%. The other $125,000 of that gain is subject to capital gains tax of 0, 15, or 20%, just depending on what bracket you fall in.
I remember sitting down with you maybe about a year ago, and for the first time realizing that when you sell something and you're paying taxes on that gain, it's almost different buckets. So
right.
Like, hey, on this portion of money, this $10,000, you're paying this much in taxes.
Right.
On this next $30,000, you're paying this much in taxes. On this $50,000, you're paying different rates for different
correct
buckets of money, so to speak. And I remember I never realized that until you broke it down.
Right. So in the event that we keep our example strong, you sell a property for $400,000. The first $245,000 is called the recovery of basis or recovery of capital, which isn't taxable at all, obviously. Right. Which you consider that when determining your gain in the depreciation recapture, because obviously we know that you're only subject to the tax on the gain of the property. So again, same concept, but your gain or the proceeds are broken down to recovery of basis, depreciation recapture, capital gains.
Yeah. Nice. So we're taking a little bit each year, right? That $10,000 per se, and we can only write it off against the income from that property, or can it go beyond that?
Only the income from that property.
Okay. If only there was a way where we could, instead of taking $10,000 each year, if we could fast forward and take the first $50,000 or $100,000, forward it up to year one, and write that off against active income. And I say that as a transition because we're 10 seconds away from the next segment, but is something like that possible? Can I, instead of doing $10,000 in depreciation write-off every year, could I take a huge chunk and use it to offset some of the income that I make, say, as a realtor or Airbnb owner or whatever?
Yeah, and that's a great question, and it's subject to a lot of answers. One thing you'll learn real quick in taxes, there's no such thing as a quick question. So let's start off with the depreciation acceleration. So instead of depreciating your rental residence over 27 and a half years, you can do what's called a cost segregation. And you and I have undergone cost segregations on your properties. So Mike does have experience with that if you're looking to utilize that as a tax strategy. And what the cost segregation does is that it allocates portions of your purchase price to different components of the house. And you need an engineer to do it. You can't just, walk around your house and say, you know what, 30,000 to my cabinetry, 40,000 to my flooring, et cetera. You need an actual guy to come out and say, you know what, I'm certified in this. This is what, your purchase price is allocated to. But what that does is it allows you to depreciate your assets on a faster schedule. Instead of the entire house being subject to the 27.5 depreciation schedule, if they allocate 30,000 to the flooring, which is only subject to a 7-year depreciation schedule, you can take that portion of the property and that depreciation over 7 years. And if you utilize other components of the tax code, such as bonus depreciation and Section 179 depreciation, you could actually accelerate it even further and get all of the depreciation from that component of the house in 1 year.
So what is bonus depreciation?
So bonus depreciation is just essentially what it sounds like. It's a depreciation on qualified property in the first year. So it's subject to 5, 7, and 15-year class life assets. And in the event you do a cost seg and you have cabinetry in your house that's worth $10,000, since it's subject to a 5-year class life or depreciation period, you can expense the entire depreciation of that class life asset in year 1 versus waiting the 5 years.
Right. And what are the consequences of that, or I guess the long-term impacts of doing bonus depreciation versus just riding out the 10,000 every year for 27.5 years?
Right. So again, that sneaky depreciation recapture topic rears its head, because if you do the accelerated depreciation method and you recognize depreciation in year 1 on half the components of your house, and you go to sell your house 5 years from now, you're recognizing more of a gain at ordinary income tax rates than you would normally if you were just depreciating that asset over 27.5 years. It's why it's very important to get with your tax professional and actually do planning, because in the event that you try to do these things on your own, you just, you can mess yourself up. So.
Yeah, and a good example of that is sitting down with you before we did those cost segregation studies. I remember one of the questions is, hey, are you going to sell any of these properties?
Right.
Like, are you even thinking about selling any of them? And there was one where I was like, yeah, I'm thinking about it. He's like, and you said, well, don't do it.
Right.
Don't, because you're essentially wasting the money for the cost segregation study and whatever prep and all that stuff if you're just going to end up selling it in 2 years.
Right. Yeah, and there's a lot of tax planning techniques that we can sit down and talk about, but I definitely would say if you plan on selling a property soon, you probably shouldn't utilize the cost segregation. It's more of a buy and hold strategy, but in the event that you do sell a property, there are other ways to mitigate that gain by, acquiring another property and having, the depreciation from that property offset some of the gain. So it's just like a planning, it's a game essentially, and you got to learn how to play. And when you play it, you can do things and recognize little tax even if you do sell. So,
yeah. And I know they've sort of started to kind of peel back on that 100% bonus depreciation, but there's been news of maybe 100% coming back. Is that official yet, or are we still waiting on anything? So
we're still waiting on that. That is a provision of the tax bill that is hung up in the Senate currently. So the House of Representatives, they voted on this tax bill and have passed it, and now it's waiting in the Senate to be read and voted on. Okay. And the name of this tax bill, for anyone who is interested, is the Tax Relief for American Families and Workers Act of 2024. They never make the name short. I don't know why. But in the event that it's voted on and passes in the Senate, it goes to the president to sign into law. And in the event that happens, the 100% bonus depreciation is here to stay. So currently, 2023 was the last year that you can buy qualified property and take 100% of the first year depreciation. And for the next 5 years, starting in this year, it phases out 20% per year. Gotcha. So this year, if you buy a qualifying asset, the max that you can get in the form of bonus depreciation is 80%. Next year is 60%, the following year is 40%, and the year after that is 20% until it drops down to zero.
Unless this gets passed.
Unless this gets passed, yes.
And I know we're over the time, but one last question. If I bought a property back in 2022, can I go back in time and still take advantage of bonus depreciation, cost segregation, everything we're talking
Yeah,
about?
so in the event you go back in time and you're like, man, I was depreciating this asset over 27 and a half years, you can do a cost seg and do what's called a 481 catch up of depreciation. And what it does is it allows you to catch up, quote unquote, all the depreciation that you should have taken over those years if you implemented a cost segregation study. So let's just say for 2022, if you should have recognized $40,000 of depreciation, instead of going back and having you amend those returns, the IRS lets you do a catch-up one-time depreciation deduction in the current year for the depreciation you should have taken.
Oh, wow. That's huge.
Yeah.
So it doesn't need to be a property you bought this year. It could be one you bought in the past that
Right.
you didn't know about this. You can go back in time.
Correct. And even in the event that you do a cost segregation study, you don't have to implement the cost segregation study. Like you can just have it and say, 3 years from now, I'm going to implement this. Not sure why you would do that because you would have to pay for the study, obviously.
Right.
But just because you obtained the study and paid for an engineer to come out and survey the property and take a look and allocate the purchase price of the property to different components doesn't mean you have to utilize that strategy that year you did the study.
Oh, interesting. Okay. And let's say, hypothetically, I took advantage of this cost segregation and bonus depreciation, and I was able to accumulate a $50,000 depreciation loss for this year, but I only made $10,000 in income from that property. What good does that remaining $40,000 do? Can I apply that to my active income as a realtor or a W-2 employee or a builder or whatever? Can I apply that loss to my active income, and what does that look like?
So short story is you can't, unless you qualify for what the next topic is going to be, which is real estate professional status. The IRS deems losses from rental real estate activities as passive. They're automatically categorized as passive losses, which means that it essentially can't be offset against other active income.
Okay.
The tax law states that passive losses can only be offset by other passive gains. So there's essentially two ways to utilize those losses is to have other passive income generators, which people call PIGs as the acronym. Have other passive income generators in the form of businesses that you don't materially participate in, or to qualify for real estate professional status, which would color those passive losses as active losses.
Okay. And so how does somebody qualify for real estate professional status? What does that look like?
So there's a few hurdles you have to jump to qualify for real estate professional status, and it's a topic of heavy, I don't want to say debate, but it's heavily scrutinized. That's the word I'll use. The IRS realizes the abuse that's associated with real estate professional status because, as you can imagine, a lot of people would like to qualify for it, and sometimes, a large portion of them don't qualify for it.
Right.
But in order to qualify as a real estate professional status and to avoid, the adjustment of your return in the event of an audit, is you have to essentially jump over 3 hurdles. The first of which is called material participation. You have to materially participate in your residential rental activities. And there's a few hurdles even there in the material participation that we'll save for afterwards if you guys are interested, because we could just have, again, another 30-minute topic on material participation. But material participation is one. You have to devote at least 750 hours to your rental activities, and over half of your time has to be devoted to rental activities as well. So as you can imagine, if you have a normal W-2 job and you have a rental property that you're trying to qualify as real estate professional status for, the likelihood of that happening is very slim to none.
Right.
Because in the event of an audit, they're going to look and say, well, you have this W-2 job. How is over half of your time being spent managing, operating, constructing, or developing, real estate? It's not. But in the event that you can qualify for it, like your situation where you're a broker, you're an agent, you're a real estate investor, you manage your own properties, etc., what they would want to see is a log of your activities. So what most people like to do who qualify for real estate professional status is buy a calendar specifically for the real estate professional status and then log the activities on the specific dates so that they can give the auditor in the event of an audit. So it's all about logging and tracking, and I mean, it's not ideal to have to like do all of that, but any event that an auditor wants to come and revoke your real estate professional status, it's going to be worth your while to have that log ready.
Yeah, absolutely. And I agree. I think that is probably the number one, or at least in the top three of, excuse me, of like the current real estate guru space. Like that's the topic. Like all you gotta do is get an Airbnb, you qualify for reps, and you never pay taxes again in your entire life. And I think that's part of like the automobile thing. All you gotta do is buy a Mercedes G-Wagon, right? You'll never pay taxes. So I do think that this is one of those areas where people take that glimmer of truth in real estate professional status and stretch it out over to make it look like this thing where a lot of those folks may not quite qualify.